All right, let's talk about something that sounds incredibly boring, but is actually a bit of a big deal: the trade deficit. Imagine your household budget. If you spend more money on stuff from the shops than you earn from your job, you've got a personal deficit. Scale that up to a whole country and bam, that's a trade deficit. It means America, as a nation, is buying more goods and services from other countries than it's selling to them. Think of it as a giant national shopping spree, where the credit card bill is perpetually higher than the paycheck from our international sales department. It's a number that gets thrown around a lot, especially by politicians who either want to scare you or make you think they're economic superheroes. So why should you, a perfectly reasonable person who probably just wants to watch cat videos in peace, care about this? Well, a persistent trade deficit can have some pretty hefty consequences. It can affect the kinds of jobs available in the country, the strength of our industries, and even how much stuff we can afford to buy in the future. It's tied into the national debt because, guess what? If we're constantly buying more than we're selling, we often have to borrow money or sell assets to cover the difference. It's like paying for your groceries with a loan shark's money. Eventually, they'll come knocking, and it won't be to borrow a cup of sugar, I can tell you that much. This isn't just abstract economics. It has real-world implications for everyone. Now, it's not all doom and gloom, or at least economists love to argue about how much doom and gloom is appropriate. Some will tell you a trade deficit means our economy is strong, that we're rich enough to buy all this lovely stuff from overseas, and that foreigners are eager to invest their money here. And sometimes, that's true. We get access to cheaper goods, a wider variety of products. Who doesn't love a cheap flat-screen TV or an exotic fruit that's out of season locally? It means our consumers are happy campers, filling their homes with things made efficiently elsewhere. But, and it's a big but, like a Kardashians, it can also be a sign of underlying problems. The truth is, the trade deficit is a complex beast, a bit like trying to understand the offside rule in football, or why anyone still listens to Nickelback. It's influenced by global economic trends, the value of our dollar, consumer habits, and international trade agreements that are often as thrilling to read as a phone book. For decades, the US has been running one, and it's become a major talking point, a sort of economic bogeyman that presidents love to promise they'll vanquish. So, understanding this isn't just for economists in tweed jackets. It's about understanding a fundamental part of how our country interacts with the rest of the world, and how that affects our wallets and our future. So, how did the good old US of A, a country that once prided itself on making everything, end up consistently buying more than it sells? Well, it wasn't an overnight oopsie. For a good while after World War II, America was the world's factory, selling more than it bought. We had trade surpluses, which is the opposite of a deficit. But then, around the 1970s, things started to shift. The trade deficit began to creep in, like an unwelcome house guest who overstays their welcome and eats all your snacks. It wasn't a sudden crisis, more like a slow burn that gradually became a persistent feature of the American economy. A bit like that one relative everyone has who just always needs to borrow $20. Several big factors played a role in this transformation, and no, it wasn't one single person or a secret cabal of foreign agents plotting our economic downfall. Globalization was a huge one. Companies realized they could make things cheaper in other countries, especially in Asia, where labor costs were lower. This led to a lot of US manufacturing jobs packing their bags and heading overseas. American consumers, bless their spendthrift hearts, also developed a huge appetite for these imported goods. We love a bargain. Add to that our need for foreign oil and the unique position of the US dollar as the world's main reserve currency, which makes it easier for us to buy things internationally. There were some key moments that really put the trade deficit on steroids. During the 1980s, under President Reagan, policies like deregulation and tax cuts, alongside increased import flows, saw the deficit balloon. Then, in 1994, the North American Free Trade Agreement, or NAFTA, came along. While it aimed to boost trade all around, it also contributed to the deficit's growth by making it easier to move goods and production between the US, Canada, and Mexico. Another significant milestone was China joining the World Trade Organization in 2001. This opened the floodgates for Chinese goods to enter the US market, and our deficit with China, in particular, shot up dramatically. Keeping track of all this buying and selling is the job of serious government bodies like the US Commerce Department and the Bureau of Economic Analysis. They're the official scorekeepers. But the story they tell isn't simple. It's a complex interplay of US economic policy decisions made over decades, the relentless march of global economic forces, evolving international trade pacts that are usually about as exciting as watching paint dry, and, crucially, the everyday choices we all make as consumers. So, it's less about finding a villain who started the deficit, and more about understanding a long, evolving economic saga. So what actually happens when a country like the US consistently buys more stuff from abroad than it sells? In the simplest terms, it means more money is flowing out of the country to pay for those imports than is flowing in from selling exports. Think of it like a national bank account, where the withdrawals for foreign goods are larger than the deposits from foreign sales. This net outflow of currency is the basic mechanical effect. It's like your bathtub draining faster than you can fill it. Eventually, you might run out of water, or in this case, the means to easily pay for what you're buying from others without some consequences. Now, believe it or not, there can be some upsides, or at least things that aren't immediately terrible. A trade deficit can sometimes indicate that a country's economy is booming. People have jobs, they feel confident, so they buy more stuff, including imported goods. It also means consumers get access to a wider variety of products, often at lower prices than if everything was made domestically. This can help keep inflation in check, which is generally a good thing. Plus, that money we send abroad often comes back to us in the form of foreign investment in US assets, like stocks, bonds, or real estate. Foreigners see the US as a safe place to park their cash, which helps fund our economy. However, if a trade deficit gets too large and sticks around for too long, it can bring some serious headaches. One major concern is increased foreign debt. If we're constantly spending more abroad than we earn, we have to finance that difference, often by borrowing from other countries or selling off domestic assets. This means the US becomes more indebted to the rest of the world. Another big issue is the potential loss of domestic manufacturing jobs and entire industries. When it's cheaper to make things elsewhere, US factories can struggle to compete, leading to closures and job losses, which can hit communities hard. This isn't just a number, it's people's livelihoods. There's also a risk, though often mitigated for the US, because the dollar is so widely used that a persistent deficit could put downward pressure on the country's currency. If the dollar weakens significantly, imports become more expensive, which can fuel inflation. And while foreign investment is good, relying too heavily on it can make the economy vulnerable to sudden shifts in investor sentiment. Many economists today still argue that the US deficit often reflects strong American demand and the dollar's unique global role, rather than pure economic weakness. But it's a balancing act, and a persistent large deficit is a clear signal that the economic scales are tipped in one direction. Presidents love to talk a big game about the trade deficit, like it's a dragon they alone can slay. Let's look at some recent attempts. George W. Bush, bless his heart, was in office from 2001 to 2009. He was generally a fan of free trade. China joined the WTO on his watch, and he pushed for trade deals like CAFTA. Reducing the deficit wasn't exactly top of his to-do list. And surprise, surprise, it grew, especially the bit with China. It was less a wrestling match and more like politely holding the door open for more imports, hoping for the best, which, economically speaking, is often a bold strategy. Then came Barack Obama, from 2009 to 2017. He tried to amp up exports with something called the National Export Initiative. He also negotiated the Trans-Pacific Partnership, or TPP, a massive trade deal. Though a bit like a blockbuster movie that never gets released, the US didn't end up ratifying it. There was a lot of talk about bringing manufacturing back, especially after the 2008 financial crisis, nearly tanked everything. Despite these efforts, the trade deficit, much like a particularly stubborn stain on your favorite carpet, persisted. It seemed that just asking nicely for other countries to buy more American stuff wasn't quite cutting it. Enter Donald Trump, president from 2017 to 2021, who made reducing the trade deficit a cornerstone of his America First policy. He viewed it as a sign of economic weakness, like America was getting ripped off. So he slapped tariffs on goods from China, the EU, and others, basically saying, "Oh, you want to sell here? It's gonna cost you." He renegotiated NAFTA into the USMCA and pulled the US out of TPP talks. The trade deficit with China did shrink a bit, but the overall deficit, it pretty much shrugged and stayed stubbornly high. Joe Biden, who took office in 2021, has kept some of Trump's tariffs, but also focused on Buy American policies, supply chain resilience. So we're not so reliant on one country for, say, tiny computer chips, and big spending bills like the CHIPS Act and Inflation Reduction Act to boost domestic manufacturing. The deficit has wobbled up and down, a bit like a drunken sailor. So, what are the brilliant ideas for fixing this thing now in 2025? Well, there's a whole menu. We could try to supercharge exports with incentives. We could push for more made-in-America stuff through industrial policy subsidies, tax credits, you name it. Tariffs are still on the table, though they can backfire and make things pricier for everyone. Some whisper about weakening the dollar, but that's like trying to steer a whale. Negotiating new, fairer trade deals is another classic. Attracting more foreign investment helps pay the bills. Making our supply chains more robust and diverse is a big one. And of course, encouraging Americans to save more and invest domestically could help. Understanding this persistent deficit is crucial because it's a reflection of America's economic health, its role in the world, and ultimately, it impacts the prosperity of everyone living here. It's complicated, it's messy, and it's not going away anytime soon.